Kind of interesting because initially when the statement came out, 25 basis point hike, and you're right, the markets expected that. But the statement itself was a little bit more hawkish, and you saw the S&P 500 initially sell off. And then Jerome Powell, he does his press conference about 30 minutes after the statement, and he's always had this very relaxing tone and kind of soothing tone. And he kind of walked a lot of the scary stuff back. And then the markets just went off to the races for the rest of the day. So it was kind of a fake out initially. The markets dumped, and then all of a sudden they rebounded and we're continuing higher today. So remarkable. But I think the bottom line is the Fed is taking inflation seriously. But at the same time, they're aware of the geopolitical issues going on out there, high oil and how that's impacting the market. And they're kind of letting the market know that, yes, we're going to attack inflation, but we're going to try not to overdo it.
Yeah, I definitely heard some commentary around, the initial scare, and then Jerome Powell came on and he calmed everybody down. So what do you think the market should be paying attention to? The words that we got first, or the soothing follow-up from Powell?
Yeah, that's such a good question. I think for the most part, Powell is trying to walk this very tight line where he knows he has to rein in inflation, right? So he wants to make sure that statement gets out there so that they're covered if they have to work harder and raise interest rates more. But at the same time, he doesn't want to create a market sell-off of epic proportion like in 2018 when the markets dropped 20% in 6 weeks, because then all of a sudden you're seeing the economy go into recession and then you can't hike interest rates. So this is a wild kind of period of time where the Fed is boxed in. It was easy when inflation was under 2% to say, oh, well, we'll print more money. Now with 10% or 8% inflation, you really can't. So I think for the most part, they're going to have to act pretty sharply. But I do think that comes with a lot of risks of slowing down the economy.
Right. And you mentioned these concerns about recession. That's something that I've seen in the headlines today. People are concerned about that. Do you think that those worries have any merit to them?
Yeah, I do think they do. I mean, if you look at the Federal Reserve actions for the last 20 plus years, the Fed has been very poor at just doing the right amount, whether it's on quantitative easing side in terms of stimulus or when it starts to raise rates. They always seem to react bigger or more aggressively than they should. And I do think that the market should be worried about that the Fed is getting a lot of pressure from the government to make sure that they rein in inflation. A lot of Americans are getting hurt by the inflation. And I think that they're getting pushed to do it harder and faster. And that definitely will slow the economy. And again, you have this rebound from COVID, which is a positive. It gives the Fed a little bit more of a, kind of ability to raise and to kind of not cause a recession yet. But at the same time, you have to be aware of what's going on with Russia invading Ukraine, what's going on with high oil. Those are all things that can also slow the economy. So it is a crazy conundrum right now. And it's going to be interesting. I think we'll know in the second half of the year. And I think that the forecasts I'm showing are actually showing that we do have a pretty decent risk of a recession by the fourth quarter or early 2023.
Yeah, it's very much like a, Goldilocks kind of situation, not too much, not too
Yeah.
little, not too hot, not too cold. So we've talked about this before, what the path for rate hikes could look like into 2022. Now that we've actually had one, there's lots of different opinions out there. Do you have any updated thoughts on what we may see through the year?
Yeah, I know as of yesterday, the market was kind of anticipating 8 rate hikes in 2022. I think at most you'll get 4 out of the Fed. And the thought process, again, is that the more they raise, the more the market, kind of the metrics of the market, the PE ratios have to come in. And at some point, you're going to see this kind of wealth effect evaporate that we've been experiencing for multiple years with the stock market always making new highs. So when that evaporates, it's going to create a very slow economy as there's going to be lack of buyers, lack of consumers buying. And I do think the Fed won't be able to fully get the interest rates to where they want without pushing us into a very dramatic recession.
Okay, and let's talk also about what gold reacted
Mhm.
to in the wake of the meeting. What do we see from the yellow metal?
Yeah, so gold initially sold off with the market as it was the hawkish initial statement, and then it kind of rebounded just a little bit. And we've seen gold have a monster breakout, and again, that's something I've talked about with you many times prior in interviews about that coming breakout. We've now seen gold starting to come back in. In fact, let's take a quick look at the chart here. So basically, this was the breakout. Remember this trend line here sloping down. We got the breakout, and then we got a big move up. And essentially, the move took us to what you would essentially, as a technician, say was a double top. Double tops, notorious resistance points. So you expected gold to pull off here. In fact, I unloaded my long swing trades in gold into this move. Now, what I'm doing is oftentimes after a breakout like this, you'll have what's called a retrace to the scene of the crime, which was the breakout line. So I'm kind of expecting a pullback to maybe 1850 or so. And then right around there, I think that's the big buy for the next big move up. I do think at that point, gold takes out this high here, which was the 2020 high as well. And I think you're off to the races much, much higher. And again, the thesis for this is basically that there's no way the Fed is going to be able to get fully away from printing money. In the short term, yes, they're stopping, they're going to raise interest rates. But as soon as we get into a scenario where the economy really starts to go into a deep recession, the only way they have really to do it is to stimulate. And the government can stimulate by spending bills, but that's also, inflationary, right? The Federal Reserve can stimulate with quantitative easing, but that's inflationary. So the long term is just so rosy for gold that, again, on pullbacks, you have to be buyers, especially with the breakout that we have seen here recently.
Yeah, and so that's what's been going on with gold and the Fed. We haven't had a chance to speak since everything started going on between Russia and Ukraine. We saw a really big move in gold. It's since pulled back. I wondered if I could get your thoughts there because, we hear a lot that geopolitical events provide a short-term boost, not long-term. What are your thoughts on what we've seen?
Yeah, so I kind of agree with that geopolitical stuff, assuming it ends and it doesn't continue for long periods of time, that run to safety is a run into gold. And so again, when we saw the spike up to over $2,000 an ounce, I think that was right in the midst of kind of the crazy initial move with Russia invading Ukraine. And the thesis for the pullback, right? So we've already pulled back from about 2075 back down to about 1940 today on gold, is that I do think that there will be some peace deal worked out in the next week or two. And I think that when you get that, you'll get an initial sell-off in gold. Now, that's just the initial reaction. Just like the pop-up when the invasion started, you're going to see a quick reaction to the downside. And as investors, as myself, I will be looking to buy that. Because once the dust settles, once that invasion, once let's say peace comes back to that area, then people will start saying, okay, now let's focus back on inflation and what the Fed is going to do. And ultimately, again, there's no way to really get long-term inflation back under 2%, in my opinion, without having really, some sort of depression and really flush out.
Okay, and I hope that we could also talk about, trading during times of war and conflict, just in general, not even related to gold.
Yeah.
Because I know that last week you could there are so many things going on. You could take your pick of what commodity or area was doing something interesting. What advice do you have?
Yeah. So number one is when things are most fearful, that's when you have to be a buyer. And we've seen it so many times over. A great example of this is that if you bring up the NASDAQ 100, right? So this low on the NASDAQ 100, that was when the markets opened, when the initial invasion took place. So you saw panic and fear. Russia was invading Ukraine, and it actually turned out to be the short-term low on the market. We rallied up. Then we came in, and again, we're rallying to the upside. And so that low is holding at this point. The reason why that's happening is because investors realize that the Federal Reserve may move slower on hiking, which means more money in the system with the invasion going on. So again, in the short term, those type of blips on the screen are usually kind of inverse reactionary things where you go opposite of if it's fear, you buy, if it's greed, you sell. Another great example of this was with the Chinese stocks. Chinese stocks had one of their biggest bounces, if not biggest bounce ever. Alibaba was up like 36% yesterday. Now, if you looked at what it did just prior